Gold is not moving the way most people think it is. Most people see the price go up, maybe hear a few headlines about inflation, central banks, uncertainty, war, debt, maybe even recession, and they assume this is just another cycle, another temporary panic, another moment where investors run to safety, then go right back to chasing stocks, real estate and easy money. But what if this is not a normal move? What if gold is not simply rising because the world feels unstable, but because the foundations of the entire financial system are starting to shift underneath our feet? That is the part almost nobody wants to face. Because if gold is sending the signal many believe it is sending, then this is not just about one metal getting more expensive. This is about trust breaking down. Trust in currencies. Trust in governments. Trust in the idea that debt can expand forever without consequence. Trust in the belief that central banks can print their way out of every crisis and somehow keep the system stable at the same time. For years, people were trained to think gold was old-fashioned, unproductive, boring, something paranoid people bought when they were afraid of the future. The modern world moved on. Tech became glamorous. Risk became intelligent. Leverage became normal. Paper wealth exploded, and gold was pushed into the background like a relic from another era. But history has a strange habit. Every time the financial world becomes too confident, too engineered, too dependent on promises instead of substance, gold comes back into the picture. Quietly at first, then suddenly, and by the time the crowd notices, the reset is already underway. What makes this moment different is not just that gold is strong. It is who is buying it, why they are buying it, and what that says about the next chapter of money itself. Because the biggest gold reset ahead may not look like a dramatic event on one single day. It may look more like a slow transfer of power, a silent repricing of trust, a moment where the old assumptions about wealth protection stop working, and the people who prepared early begin to move very differently from everyone else. And that is where the real story begins. For decades, the global financial system ran on one invisible force above all else: confidence. Confidence that paper currency would hold value. Confidence that government debt was safe. Confidence that central banks were in control. Confidence that if anything broke, policymakers could step in, cut rates, print liquidity, calm markets, and restore order before panic spread too far. That confidence became the operating system of modern finance. It allowed countries to borrow far beyond historical norms. It allowed consumers to spend future income before earning it. It allowed markets to trade at valuations that only make sense in a world where stability is assumed. And it allowed entire generations to believe that financial risk had been tamed by institutions, models, and intervention. But confidence is a fragile asset. It grows slowly, then breaks all at once. And what most people miss is this: gold does not need the system to collapse in a Hollywood-style disaster to become important. Gold only needs one thing: a decline in trust. Not necessarily panic, not necessarily chaos, just enough doubt. Enough doubt that inflation may not go away as easily as promised. Enough doubt that debt can no longer be managed without currency debasement. Enough doubt that the people in charge are no longer solving problems, only delaying them. Enough doubt that the old safe assets are not truly safe anymore. That is when gold starts changing roles. It stops being seen as a commodity and starts being seen as a mirror reflecting the real condition of the system. When trust is strong, gold looks unnecessary. When trust weakens, gold begins to reveal what paper wealth tries to hide. Think about the psychology of it. A currency is valuable because people believe it is valuable. A bond is safe because people believe the issuer will honor it without destroying the currency in the process. A financial asset is stable because people believe there will be enough liquidity, enough growth, and enough institutional control to support its price over time. But gold does not rely on those beliefs in the same way. Gold does not need a central bank meeting. It does not need earnings growth. It does not need a bailout. It does not need a promise. And that is exactly why it becomes dangerous to ignore in periods like this. Because the more complex the financial world becomes, the more attractive simplicity becomes when fear enters the room. And gold is simplicity. It is not exciting. It is not innovative. It does not pay yield. It does not tell a story about the future. It simply sits there with a message the modern world hates to hear. Real wealth and financial promises are not the same thing. That message becomes explosive when debt levels are extreme. The world has built a mountain of obligations on the assumption that growth, low rates, and monetary intervention can continue forever. Governments owe more, households owe more, corporations owe more. Entire economies have become addicted to cheaper money and rising asset prices. The machine only feels stable as long as the cost of maintaining it stays manageable. But once inflation becomes stubborn, or rates stay higher than expected, or growth slows while debts remain massive, the machine starts revealing its weakness. Now policymakers face a trap. If they keep policy tight for too long, they stress the debt-heavy system. They pressure governments, consumers, banks, and markets. But if they ease too aggressively, they risk weakening currencies and reigniting inflation. Either path creates doubt. Either path pushes investors to ask a question they have avoided for years. What is actually safe anymore? And that question is where gold starts to matter in a very different way. Because in an environment where both growth assets and traditional safe assets become harder to trust, gold is no longer competing with stocks alone. It is competing with the credibility of the entire framework. That is why this move feels deeper than a normal cycle. This is not just about fear, it is about recognition. Recognition that the old model may be entering a phase where every solution creates a new problem. Recognition that policy tools are becoming less powerful and more costly. Recognition that the line between stabilizing the system and quietly devaluing money is becoming harder to see. And when that recognition spreads, gold does not need everyone to agree. It only needs enough serious capital to reposition. That is already a massive change. Because the real gold reset is not driven first by the retail crowd. It is driven by those who understand what gold means when institutions themselves begin preparing for a world of lower trust. And this is where the story gets even more important. When the average person thinks about gold buying, they imagine small investors, survivalists, maybe wealthy families, trying to hedge uncertainty. But the deeper signal often comes from actors who do not buy based on emotion. They buy based on strategy, central banks, sovereign institutions, long-horizon capital, countries thinking in decades, not quarters. And when those players begin accumulating gold in a serious way, it tells you something bigger is happening beneath the surface. Because these are not people reacting to headlines. These are institutions reading the long-term direction of monetary power. They understand that reserve currencies are not permanent. They understand that debt-based systems can survive longer than expected, but not without consequences. They understand that geopolitical fragmentation changes how countries think about settlements, reserves, sanctions, and dependence, and they understand that in a world where financial alliances are becoming less stable, neutral reserve assets become more attractive. Gold sits in a very unique position here. It is no one else's liability. It cannot be printed. It carries no counterparty risk in the traditional sense. And in a fractured world, that matters more than most people realize. This is why the current gold story is not just about inflation. Inflation is only the visible layer. The deeper layer is strategic mistrust. Countries are watching what happens when reserve systems are weaponized. They are watching debt burdens expand. They are watching currencies lose purchasing power over time. They are watching how quickly stability narratives can change when crises hit. And they are adapting. That adaptation may not look dramatic in one moment. It looks like 1,000 quiet decisions. More diversification, more physical reserves, less blind dependence on any one monetary centre, more interest in assets that preserve sovereignty. Gold becomes valuable in that environment, not because it replaces the whole system tomorrow, but because it protects against the system changing faster than expected. That is a crucial difference. Many people think a gold reset would mean some giant announcement, some overnight collapse, some return to a formal gold-backed currency structure. But real resets rarely happen in a clean, theatrical way. They happen through behavior first. People adjust before institutions admit the shift. Institutions adjust before the public understands the shift. Markets price in danger before headlines explain it. That is why waiting for official confirmation is so dangerous. By the time the system openly admits trust is deteriorating, the repricing is already far along. And this is where ordinary investors often get trapped by old thinking. They are taught to chase what has already performed. They are taught to dismiss what seems outdated. They are taught to measure value through momentum, convenience, and social proof. Gold does not fit that psychology well. Gold requires patience. Gold requires humility. Gold requires accepting that the system may not remain as stable as it looks on the surface. That makes it uncomfortable, and discomfort is usually the price of preparation. Look at how most people behave around financial turning points. At the top of a bubble, they feel safest. At the bottom of a crisis, they feel certain the pain will never end. Human beings confuse recent stability with permanent stability, and recent chaos with permanent chaos. That is why so few position themselves before the crowd. When everything feels normal, protection seems unnecessary. When protection becomes obviously necessary, it is already expensive. Gold operates in that exact psychological gap. It often moves before the average person emotionally catches up. It moves while people are still debating whether there is even a problem. It moves while the crowd is distracted by short-term narratives. And that early movement is what creates the biggest transfer of wealth and security. Because the people who understand this early usually move differently. They stop asking whether gold is exciting. They start asking whether the world ahead will reward blind trust in paper systems the way the world behind us did. That is a much harder question, and a much more important one, but that is only the surface. The bigger shift is happening underneath the price itself. Most people think the danger is missing a gold rally. That is not the real danger. The real danger is misunderstanding what a major gold move says about everything else. When gold rises sharply in a fragile macro environment, it is not just an opportunity signal, it is also a warning signal. A warning that real rates, inflation expectations, debt fears, currency concerns, and institutional behavior may be colliding in ways the public is underestimating. A warning that traditional portfolio assumptions may not hold the way they did in the last era. A warning that what looked diversified on paper may actually be concentrated in the same system risk. And this is where the real danger begins. Because most people think they are protected when they are simply spread across different versions of the same vulnerability. A retirement account full of equities, bonds, real estate exposure, and cash can still be highly dependent on one thing: confidence in the financial system itself, confidence in policy, confidence in liquidity, confidence in fiat purchasing power over time. If that confidence weakens broadly, then the illusion of diversification can disappear faster than expected. That is why gold matters so much in reset periods. It behaves differently because it represents something different. Not growth, not credit, not leverage, not optimism, constraint. That word changes everything. The modern financial system is built on expansion. More debt, more liquidity, more credit creation, more promises, more forward pulling of demand. Gold represents the opposite principle. It represents a form of wealth that cannot be expanded at political speed. That is why gold becomes so powerful when the expansion model starts losing credibility. Imagine a town where every building was built from painted wood made to look like stone. For years, everyone praises the architecture. Prices rise, confidence grows, wealth appears everywhere. Then one season of heavy rain reveals that much of what looked permanent was surface-level strength. Suddenly, the only true stone structures in town are revalued. That is gold in a financial storm. It does not become valuable because it changed. It becomes valuable because perception changes, and perception is starting to shift. People are beginning to realize that inflation was not just a temporary annoyance. It was a signal that purchasing power is more fragile than many assumed. Higher rates were not just a technical adjustment. They were a glimpse of how dependent the system had become on cheap money. Banking stress was not just an isolated event. It was a reminder that liquidity can evaporate when confidence slips. Massive government deficits were not just accounting details. They were evidence that the system increasingly solves present pain by borrowing from the future. Each of these may seem manageable on its own. Together, they tell a very different story. They tell a story of a system that can still function, still grow in bursts, still rally in markets, still generate optimism, but with rising structural fragility underneath, like a bridge that still carries traffic even as stress fractures slowly spread through the foundation. That is the kind of environment where gold does not just drift higher, it can reprice, and a repricing of gold is not trivial because gold is ancient money psychology. It sits at the intersection of fear, memory, and sovereignty. When it moves, it pulls on forces much older than modern asset allocation models. It wakes people up to the possibility that preserving wealth and growing wealth are not the same mission. During easy eras, people forget that. During reset eras, they learn it fast. And the tragedy is that many only learn after damage is done. After cash loses more purchasing power than expected. After bond portfolios fail to protect the way they were supposed to. After inflated asset prices deflate. After leverage turns from a wealth accelerator into a wealth destroyer. After they realize that being rich on paper and being secure in reality are two very different conditions. This is why the biggest gold reset ahead is not mainly about profit. It is about hierarchy. Which assets are trusted most? Which stores of value survive policy mistakes? Which forms of wealth stay standing when governments have incentives to dilute currency rather than accept pain? Those questions matter more now than they have in years. And once society starts asking them again, gold moves from the margins toward the center. Not because everyone suddenly becomes a gold bug, because uncertainty forces a re-ranking of what matters. The market is ruthless that way. In stable times, it rewards speed. In speculative times, it rewards risk. In reset times, it rewards resilience. Gold belongs to the third category. And yet, even here, many people will hesitate. Why? Because gold does not flatter the ego. It does not make people feel smart in the same way fast-growing assets do. It does not promise excitement. It does not give the illusion of control through endless analysis. It asks a more uncomfortable question. What if the world ahead is less predictable, less trustworthy, and less forgiving than the world that made recent wealth strategies look easy? Most people do not want to think that way, until they have no choice. That is why the final phase of a gold reset often feels sudden. Years of quiet positioning can be followed by a sharp public awakening, a break in confidence, a policy mistake, a currency scare, a debt accident, a geopolitical shock. Some visible event that forces millions of people to notice what had been building quietly all along. And once that public awakening starts, the psychology changes fast. Assets people once mocked become serious. Questions people once ignored become urgent. Protection people once delayed becomes expensive. The crowd always wants certainty before action. But certainty is the one thing markets never give cheaply. And this may be the most important lesson of all. The gold reset is not just a market event. It is a mindset test. It separates people who understand systems from people who only react to headlines. It separates those who prepare in times of comfort from those who panic in times of stress. It separates those who confuse nominal wealth with real security from those who understand the difference. Because real wealth is not measured only by how much you own. It is measured by how much of your future purchasing power, freedom, and optionality can survive a changing world. That is the hidden truth most people miss. A person can earn more, invest more, and still become more fragile if all their financial assumptions depend on one unstable system, continuing exactly as before. More assets do not automatically mean more safety. More exposure to the same underlying risk can simply mean a bigger illusion. Gold disrupts that illusion. It reminds you to ask a deeper question. What part of my wealth exists outside promises? That question becomes life-changing during reset periods. Because when a system is stretched, policymakers do what they always do. They try to preserve order, they smooth volatility, they reassure the public, they buy time. Sometimes that works for a while, but often the hidden cost is transferred silently through inflation, dilution, repression, or asset distortion. In other words, the system survives, but your money changes. That is the part people feel long before they understand it. The paycheck buys less. Savings lose punch. Safe returns fail to keep up. The cost of stability becomes a slow confiscation of purchasing power. And in that world, gold is not simply an asset. It is resistance. Resistance to forgetting what money is supposed to do. Resistance to the fantasy that printing can create real wealth. Resistance to the idea that every problem can be solved without sacrifice. That is why gold tends to attract such strong reactions. It challenges the stories people want to believe. It tells the saver that cash is not always safe. It tells the investor that paper gains are not always real gains. It tells the policymaker that trust has limits. It tells the public that comfort can disappear more gradually and more permanently than expected. But it also offers something powerful: clarity. Gold does not promise perfection. It does not solve every financial problem. It does not produce income by itself, and no single asset should be treated like magic. But gold forces discipline into a world addicted to excess. It forces historical perspective into a culture obsessed with the present moment. It forces respect for fragility into systems built on leverage and confidence. and those are exactly the qualities that matter when a reset approaches. So what should a smart person take from all this? Not panic, not obsession, not blind all-in behavior, awareness, the kind of awareness that recognizes when the game is changing, the kind of awareness that understands why old models may stop protecting the way they once did, the kind of awareness that sees gold not as a prediction of apocalypse, but as a signal that financial gravity is returning after years of artificial support. Because that is what resets really are. They are moments when reality catches up to narrative, when excess meets consequence, when trust is repriced, when the assets built for easy conditions lose status and the assets built for hard conditions regain it. Gold has survived every monetary experiment because it was never based on an experiment to begin with. Empires rise, debt expands, currencies evolve, financial products multiply, and still gold remains in the background like a quiet witness, waiting for the moment people remember why it mattered in the first place. That memory may now be returning, not because the world is ending tomorrow, but because the next era may belong less to blind expansion and more to disciplined preservation, less to easy assumptions and more to strategic positioning, less to financial fantasy and more to monetary reality. And those who see that early do not just protect themselves better. They think better, they act earlier, they panic less, they understand that the goal is not to predict every headline, but to prepare for the kind of world those headlines are pointing toward. That is how wealth survives resets. That is how freedom survives inflation. That is how confidence is replaced with caution before caution becomes common. The biggest gold reset ahead may not be announced with a bell. It may unfold through rising prices, weakening trust, strategic buying, policy traps, and public disbelief all at once, slowly enough for most people to ignore, fast enough to punish them later. And when the crowd finally realizes gold was never the story by itself, but the warning sign for a much bigger shift, the easy positioning window may already be gone. The people who move too late will think gold got expensive. The people who understood early will know the truth. Gold did not really get expensive. Paper promises just got cheaper. If you want to stay ahead of the crowd and understand the shifts that matter before they become obvious, subscribe and turn on notifications. Because in times like these, the biggest advantage is not reacting faster than everyone else. It is seeing clearly while everyone else is still asleep.